Good morning, grade 11s. Just a quick statement of financial position. So yesterday we did the current account note, and now we're going to do a full SFP. So we have to do this for the financial year ending 30 June 2024. In other words, our financial year started on the 1st of July 2023. We then have some prior year figures over here, like the fixed deposits, and then our fixed assets at carrying value, as well as our loan. And then we have the current year's figures as well. Just a quick note here with the fixed assets at carrying value. Remember that, yes, we record our fixed assets at cost, but then we also calculate depreciation. And then when we do the financial statements, we do our fixed assets note. And then we say that the carrying value of all our fixed assets added together at year end, that is then the amount that I will see in my SFP on the face of my SFP. Okay, so that's why it is okay for you to only work with your fixed assets at carrying value. Okay, right, so let's look at the further information. It says that a new vehicle was purchased for 500,000 Rand on the 1st of November 2023. So in other words, somewhere within your current financial year, you have now purchased a new asset. Then depreciation on fixed assets amounted to 320,000 Rand for the current financial year. This has been calculated correctly. Wonderful, because that means that we do not have to now calculate that depreciation amount. Equipment with a carrying value of 50,000 Rand was sold for 20,000 Rand. We know that we need to now remove this disposal at carrying value. No other fixed assets were purchased or disposed of during the year. Wonderful. Okay, so that is your fixed assets. So you don't have to calculate depreciation, so you don't have to be concerned about assets that have reached their useful lifespan. They've given you all the purchases, they've given you all of your disposals, so you are happy. Next up, the following stock was on hand to be calculated. Okay, so somewhere within the information, they will give me enough information to be able to calculate the missing figures. So what they're basically saying with that sentence or adjustment over there is they are saying that when you do your current assets, because remember that's where we find our trading stock and stationery, they're saying that when you do your current assets, you will most probably have to balance, in other words, find a missing figure to be able to determine your inventories. I just quickly need to pause. Yeah, my poor little kitten couldn't get into the room. Okay, right then. The overdue account of a debtor must be charged with interest. So in other words, we are going to add on to his account. He owes us money. Therefore, we're looking at our debtors, and remember that debtors fall under your trade and other receivables. And then you have a loan that is payable in installments of 10,000 Rand. This includes interest. Interest for the year amounted to 42,500, and interest is not capitalized. So in other words, we must pay the interest when it's due. It's not added onto this loan. And then the capital repayments for 2025 will amount to 140,000 Rand. We are so happy that they're giving us the capital repayment amount, because now we're not going to forget to remove the interest. So remember, when you want, just hold on, please. Early mornings in my house is always a mission with my kitten. Okay, right. So the loan, remember when you now have to do the current portion of a loan, you may only reclassify the capital portion that is being repaid in the next financial year. That amount does not include interest. And that's why I said it's nice that they're giving us a capital repayments amount, because a lot of the times we forget that we have to remove the interest from that capital portion to be able to do the reclassification. And then we have been given some ratios that have been correctly calculated. So see, when I said that they're going to have to give you some information to be able to balance your current assets or in some other way calculate your stationary and your trading stock. And here you go. That is your information. Okay, so now let's go to the answer book, now that we understand our adjustments. So we have here non-current assets, and that consists of our fixed assets as well as our financial assets. When we're looking at current assets, starts with inventories and trade and other receivables, and then our cash and cash equivalents. And the non-current assets plus current assets will give us our total assets. Remember that total assets must always be equal to total equity and liabilities. Then sorry, you guys. Mission. Okay, right. So then we have equity and liabilities consisting of our partners' equity. So they have contributed capital, and then they also have their current accounts. So that's the one that we did yesterday. And then non-current liabilities, we have a loan. We will still add the bank's name there if the bank's name has been given. Then current liabilities, trade and other payables, and we have already read through the information, so we know that the missing amount here is your current portion of loan. Okay. Right, so let's go back to the information to first of all see if we have a name for that bank for the loan. There we go, Best Bank. So Best. Righto. Next up. So fixed assets were purchased and disposed of during the current financial year. So remember, first of all, you started with some fixed assets. So you started with fixed assets, the carrying value of 950,000 Rand. Then it says that a vehicle was purchased on the 1st of November. So you need to now say, because remember, you are working with the prior year's figures now. You ended on 950,000. You now want to get to what am I ending with this financial year? And in order to do that, you need to now add all of the new assets that you purchased minus your disposals, minus your depreciation. Okay, so a new vehicle was purchased for 500,000 Rand, so I need to add that. Depreciation of fixed assets amounted to 320,000 Rand, and this has been correctly recorded. So 320,000. Equipment with a carrying value was sold for 20,000 Rand. We don't now care for how much they sold this equipment. We only want to know what must we remove. We must remove the carrying value. And then no other fixed assets were purchased during the financial year. In other words, that's the only thing that happened in that fixed assets account. So we have our 950,000 plus the 500,000 minus the 320 minus the 50. So we have fixed assets at year end. There we go. Okay. Right, so we don't have to do anything with the financial assets here. So the fixed deposit, that's the final amount. We're not going to change that, okay? I'm not going to think no, it has to be something else. Then the stock at year end, so we now know that we can't do it yet because they've given us the current ratio and the asset test ratio. So we would first need to finalize the current liability section in order for us to do our current assets and then balance it to find the inventories. The overdue account of a debtor must be charged with 3% interest per annum. His 5,000 Rand account has been overdue for 4 months. Okay, so first go back to your information to find the trade and other receivables before this additional adjustment must be recorded. So you currently have 10,000 Rand in that debtors control account, right? Then They are now saying that the overdue account of a debtor must now still be charged with interest. And his 5,000 Rand account has been overdue for 4 months. You charge interest at 3% per annum. So you can't now just say 5,000 multiplied by 3%, and that is the interest that you owe me, because his account has only been overdue for 4 months. Therefore, you can only calculate the interest for 4 months. So 4 out of the 12, or 142, 4 out of the 12 months. So let me just quickly get my calculator. Okay, so 5,000 times 3% times 4 out of 12. So 50 Rand is what you are adding onto this account. So it's not that bad. Okay, next up, it says that the provision for bad debts must be adjusted to 4% of the current debtors after taking into account all adjustments. There were no other debtors adjustments at year end. Okay, so remember, what is provision for bad debts? Provision for bad debts is me saying that I do not think I will be able to collect the following amount in my next financial year. So remember, we're trying to make our financial statements as accurate as possible here. And prudence says you're not allowed to overstate your assets. Therefore, remove the amounts that you think you might not be able to recover from your debtors. So your first step is to calculate what is my debtors control balance before this provision. And there we have it. It's the 10,000 that we started with in the financial information, plus the adjustment that we still had to record. Okay, that times 4%, because the provision for bad debts must be 4% of the current outstanding debtors. So you're on 10,050 times that by 4%, so 402. And remember that what you're going to do with this 402 Rand is you are now going to say that, yes, I have debtors of 10,050 Rand. However, I don't think I'll be able to recover 402 Rand of the outstanding debtors. So I'm making a provision. I'm removing it in order to see a more accurate balance of my debtors. There we go. And then they also said that this is the only information with regards to debtors at year end. So nothing else to do there. Right. The loan is repayable in monthly installments of 10,000 Rand, including interest. Interest for the year amounted to 42,500, and interest is not capitalized. Okay, so they didn't give you your opening balance, which means that you have to go to the additional information above. There we go. 1.6 million is where we started this best bank loan on. Oh, I put the best bank here. My gosh. I'll just do this. You don't have to put best bank under the current portion of loan. Sorry, I'm feeling a bit under the weather, so my brain is not functioning properly. Okay. So 1.6 million. Right, then moving on. The loan is repayable in installments of 10,000 Rand, including interest. So in other words, you have paid since the last financial year, so 2023, you have made payments of 10,000 Rand per month. So you now need to subtract that from the balance that they had at year end last year, because as with the fixed assets, you are now trying to see what is the loan balance at the end of the current financial year, starting with what I owed them at the end of the previous financial year. So I'm taking the prior financial year's closing balance, then minus the current year's repayments. It then says, however, that this amount includes interest. And interest for the year amounted to 42,500. Interest is not capitalized. So in other words, yes, you made these payments. So you made your payments every month. So you made in total 120,000 rands payments. But what they are saying is that this includes interest. And if your interest is not added onto your loan, it means that your 1.6 million here is only your capital balance that is outstanding. So you can only remove from this balance the capital portion that you repaid. And the 10,000 times 12 is your 120. But now you need to say minus the interest payments because that has not been added onto the loan. Yeah, minus the 42,500, so 77,500. There we go. Okay. Then they also said that the capital repayments for 2025, in other words, the next financial year, will amount to 140,000. So we'll go to our answer book and we'll say that of this total loan amount, so we are now currently on 1.6 million minus the 77,500. So this is currently our loan amount. But they are saying that of this balance, please note that 140,000 Rand is repayable within the next financial year. So I'm going to reclassify that as a current liability. So, oh, what did I do now? Okay, so I do not have this as a non-current liability because I am going to repay 140,000 Rand in the next financial year. Therefore, it is only, well, I'm saying only, it's a rather big amount there. That is your loan at year end. Then the current ratio and the asset-based ratio. So this means that whatever figures you now have here within your financial statements, together with amounts in the information A that you haven't yet used, that is enough for you to now be able to complete your SFP. So let's look at the amounts that we haven't yet used that's been provided in information A. Right. So first things first, they've given us the current accounts. Sorry, see, this is the reason why I've been pausing videos the whole morning. Okay, so the extract from the financial position for 2023-2024 told us that we have in 2024 at year end, we have current account balances. So we still need to include this in our SFP because SFP equity section has capital and current accounts. So for Larry had a credit balance at year end. So in other words, he had a favorable current account balance, whereas Andy had a debit balance. So that means that he had an unfavorable balance. Then we know when we're looking at the current accounts, we have to take the opening balance plus then we have to add to that the primary distribution, the final distribution to get to our total earnings for the year. And then we minus the drawings for the year to see what the closing balance is. Therefore, you still have to take into account their drawings. Okay, so the current account for Larry was a positive 75,000. And then the current account for Andy was a negative 25,000. Then we still have to subtract both of their drawings from this amount. So let's quickly do that. Okay, so we have 75 minus 25 minus 40, the two 20s. Okay, so 10,000 Rand. Things are not looking good in the current accounts. Right, so if we then add the capital and the current accounts, we will get to our partner's equity. Then we already have all of the amounts needed in our current liability, so we can add that. They said they don't want us to add the current assets, so we won't. We can, however, calculate our total equity and liabilities, and total equity and liabilities is then equal to your total assets. So let's do that. 355,900 plus 138,500 plus 148. Okay. So there we go. We have that. And then we have that. Lovely. Next up is these missing figures over here. So we still now need to calculate our inventories. And we also have to calculate our cash and cash equivalents. Okay, using our information. So it says here that the current ratio is 1,3 to 1. What does that mean? It means that for every 1 rand in current liabilities, I have 1 rand 30 cents in current assets. Okay, because current ratio is current assets to current liabilities. So for every 1 rand in current liabilities, I have 1 rand 30 cents in current assets. Then what is asset test ratio? Asset test ratio is looking at my current assets minus my inventories to current liabilities. So in other words, we can say current ratio minus asset test ratio is equal to inventories. Because what I'm saying is current assets minus trade and other receivables plus cash and cash equivalents is equal to inventories. That's true. So in other words, 1,3 minus 90 is equal to 0,4, right? Because 13 minus 9 is 4. Okay, so 0,4 times my liabilities will then give me my inventories. And then for these two, the trade and other receivables and cash equivalents, that is your 0,9 times your current liabilities. I'm doing it here in one line. I will do the split still between cash and cash equivalents and trade and other receivables. I just want to get somewhere. So now you'll see that you have your 0,9, which is your trade and other receivables plus cash and cash equivalents. And then you have your trade inventories, which is 0,4 of your current liability. So if you add those two together, you get back to your 1,3. We can double check that if you want. So you have your 0.9 plus your 0.4 to get back to your 1,3. Okay, so let's do this real quick. So we said that inventories is current assets minus trade and other receivables and cash equivalents. So that's why we subtracted the asset test ratio from the current ratio to find that difference there. So 0.4 times 148. So here we have our inventories. Okay, then current assets is 1.3 times our current liabilities. There we go. So this business is clearly not liquid. I hope that you guys saw that immediately, because current ratio is above the norm as well as the asset test ratio. Right, so now 0.9 times 148 is 133,200. Now my kitten is attacking my leg here. Okay, right, so yes, I now have it here. Okay, let me rather put it here for now. Let me not confuse you. Okay, so this is, remember now, your asset test ratio. Asset test ratio is your trade and other receivables and your cash and cash equivalents. But you are only looking for the cash and cash equivalents figure. So you're just going to minus 9,648. So you need to subtract your trade and other receivables from this amount to find your cash and cash equivalents. And there we go. Okay, so we are now not going to recalculate everything to see if assets are in fact equal to owner's equity plus liabilities. They told us do not calculate certain things, so we're just going to leave it as is. We have now done what we have to do. We are happy with our SFP, and that's doing SFP including ratios.